Cash Secured Puts Explained is the title of today's presentation. And when we talk about cash secured puts, what we're also talking about is pretty much the same thing, is selling put options. So the reason we're doing this presentation is off the back of a recent video we did titled Trading Options is Dumb. And the most common objections that we received were from individuals who suggested that cash secured puts or covered calls are both quote-unquote safe methods of generating income. So we're going to talk about that first bullet point, cash secured puts or selling puts. So let's just talk about put options to start. A put option gives the buyer of that option a right to sell 100 shares of a stock at a certain price in the future. So let's use the example of Palantir. If you bought a put at $15 a share on Palantir a month from now for $68, it's currently trading at $16.90, then here are the potential outcomes. So it costs you $68 for one contract, which represents 100 shares. So if shares trade at $15 a share a month from now, you haven't done anything because you already spent $68. So you need shares to trade at $14.32 a month from now for you to break even on that trade. If shares trade at $14 a share, you made $32 or 47% on your money. If shares trade at $15, let's say above $15, you lost that $68 and you made nothing. And of course, you can do the math going down from there. What are you doing here? Well, you're speculating on the price of Palantir shares. Speculators, as we've talked about before, rarely accumulate wealth in the long run. And if they do, they rarely keep it. Now, the biggest problem here is that there's a huge temptation to increase your risk, especially if you have conviction and you believe that Palantir shares are overpriced. You say, I really believe that a month from now they're going to drop, let's say, below $15 a share. You'd be a fool to think that you had some information advantage on all the algorithms and institutional investors out there, but what you're doing is speculating. A broken clock can be right twice a day. To 10 times that trade, so $68 is nothing, right, to most people. 10 times that, suddenly you're talking about some money. So you 10 times that trade, you buy 10 contracts, $680, 1,000 shares, suddenly you're some big swinging dick. You've increased your risk quite a bit while convincing yourself that now you're making a meaningful trade. You're just increasing risk, and it's not a good idea. So let's talk about selling a put. This is where you sell someone the right to sell you shares of Palantir at $15 a share. You get that premium, and it's always yours. So what you're doing here is hoping that you can buy shares of this company at $15 a share. Remember, it trades at $16.90 right now. So you're saying, in a month, I'm hoping it trades down around or below $15 a share, and then I can buy shares at that price. I'm willing to, and I get a premium in order to have that right. Now, you need to have the cash for that trade. So look at here. So you get the premium. Let's just take the premium and put that away. So we'll do a proper example later, but let's just assume that you got some premium that's the $68 a share that you sold that other guy who was buying the put, right? So you see yourself on both sides of this trade. So you get that $68, all right? When the option expires, if the price of the stock is below $15, then you're going to buy 100 shares at $15 a share. So when you do a cash secured covered put, then what you're going to need to do is have $1,500, right, to cover that. So your brokerage firm will require you to have that, and now that money's tied up. If the price of the stock is above $15 a share, then you keep that $68. So this is a way to generate yield on cash that you're holding. That, $1,500, and you take the 68, divide that out, figure out what yield you're getting. Now, our points of contention here surround how applicable these tools are for most investors, especially newbies. So let's talk about some assumptions here. Most investors, at least youthful investors, are saving money every month and investing in the market. All right, let's assume that. let's assume that just a minority have a windfall of cash to invest. In either case, we would recommend, as risk-averse investors, dollar cost averaging to reduce your market timing risk. Now, perhaps the durations might differ if you have a windfall and you want to get into the market versus someone who's saving money every month and investing it in the market as they're saving it. Now, various opinions exist about dollar cost averaging. We'll touch on that later. But one thing's for sure, you will sleep better at night, and here's why. If a stock that you're regularly buying at monthly intervals goes up, you're happy, your holdings are going up. You look at your account balance, wow, I'm making money. If that stock goes down, sure, you have some paper losses, but you're stoked to buy cheaper shares and reduce your cost basis. So either way, you're happy, you sleep better at night. Now, diversification is very important, all right? You have to have rules. So, for example, let's say that one stock should not equal more than 5% of your total portfolio for purchases. Of course, you let your winners ride. We trim at 10% of our portfolio. When it starts to exceed 10%, we'll start trimming. So, here's the reality of using cash-secured puts. So, the reality is this. The best way to utilize dollar cost averaging is to buy a set of assets every month. So let's look at this in as a real world example. So let's say you're making $120,000 a year. It's $10,000 a month. Nice round numbers. Let's say you're saving $3,000 a month. So you could buy every month 10 assets for $300 each. That means that if you're purchasing those assets, you could use cash-secured puts for a $3 stock or less, all right? There's not a lot of great companies out there trading at these prices. Not that the price of the stock relates to the intrinsic value, but you get the point here. The price of a stock now dictates whether you can use cash-secured puts. Now, if you took all your monthly savings and invested them in a single stock, so you had that $3,000 for that month, then you could do a cash-secured put on a $30 stock or less. So you see where you're starting to have some limitations. So let's talk about an example here. To buy 100 shares of Palantir at $15 a share, you need $1,500. So to sell the put, you need to have $1,500 in cash. If the stock falls well below that strike price, let's say to $10 a share, you'll have paper losses. But if it's a quality company you want to own, who cares? If the stock price increases and you're not long, and clearly you want to be long because that's why you're selling the put, right? You want to hold shares, you'll start experiencing fear of missing out. You'll sleep better at night if you just buy shares. For investors, selling puts is a way to get a little bit better of a price on a stock. Is it worth it? We would question that. For speculators, selling puts generates income. And you can see here this example. So this is the return for a deeper green line is just buying and selling a stock, while the lighter green line shows a put return. If you're so bullish on the stock, then why not buy it and be done with it? If you're not so bullish on the stock, then why are you buying it in the first place? Oh, you're speculating on price movements. Got it. That's exactly what's happening when you start using selling puts to generate income. Now, here's a much better example. Let's say we want to add shares of UiPath, all right? That's a company that we have high convictions on. Let's make some assumptions. So when we open a position in a particular stock, we add 30%, and then we use dollar cost averaging to accumulate the rest of that target position size. So initially, we're investing 30% of a target position size. Now, we don't want that total position to exceed 5% of total assets, as we said before. The current price of Path is $18.32. So we need somewhere around $1,800 to sell a put, minus, of course, the premium we receive. Now, our total assets under management need to be at least $111,000 to be properly diversified based on these assumptions. So you see that selling puts is something that people with larger accounts may benefit from, but not newbie investors who are just starting to grow their accounts. So let's go to Yahoo Finance here. We look at puts for August 18th. So let's say that's 35 days from now. We want to buy 100 shares of UiPath at $17.50. Now, if we're bullish on the stock, waiting longer reduces chances of getting into that position. And we can push this out for as long as you want, but then we're reducing the likelihood that premium increases, sure, but we're limiting that upside exposure. So you see that the opposing forces at play there. So let's say, here's probably a more practical example. We say a week from now, we'd like to buy shares at $17.50. So what we would get, that we'd sell that for $25. You can see there where we've highlighted the last price and the bid-ask spread. You see that there. So you're assuming that you're actually able to sell at that. But let's say that, and notice how volatile these are, right? They move very quickly. So that's something when you're owning a option that you need to consider. But when you're selling, of course, that's a different story. But what you get here is 1.4% on your money for waiting a week to possibly buy shares. Now, that $25 that you receive, it's not going to go very far. Annualized, it may be spectacular, but you're not some BSD with a massive account. And another way to think about it, what might you do in the next week to save $25? That's probably a better approach, is to increase the amount of money that you can invest as opposed to dabbling in options. Now, here are some outcomes from that trade. Remember, we wanted to buy shares at $17.50. Let's say shares never trade below $17.50 in the next week. So the $25 premium means that it essentially equates to a 25-cent variance in share price, which is nothing. The longer the time until expiration, the higher the premium we get, but the longer that cash gets tied up, and we're essentially, for a stock that we should have strong convictions on, we're not holding it. Better outcome here. Set a date, buy your shares, be done with it. Dollar cost averaging removes market timing risk. Now, some people will point to studies, and they're absolutely right. So Vanguard did this large study. There's a lot of studies that you can look at out there that show dollar cost averaging being superior or not. But it seems like the consensus from industry experts would be that lump sum investment strategies beat common cost averaging investment strategies 2/3 of the time. So you may be tempted to invest with the lump sum, but guess what? Most of you don't have lump sums. And I'll sort of give you my own personal experiences, which would be that when I was investing in the market for somewhere around a decade, I would invest throughout the year using dollar cost averaging. So I would recall buying like 30 assets a month. I would time the markets then with bonuses or tax returns. And because I was working abroad, the tax returns weren't really relevant, but bonuses were. So what I would do then is dollar cost average throughout the year. When I got my bonus, then I would do some market timing with it because I had that lump sum. Remember, sleeping well at night is going to happen a lot more when you're dollar cost averaging. As we said before, stock goes up, I'm stoked my assets under management are increasing. Stock goes down, I'm stoked to be buying cheaper shares. Selling cash secured puts adds complexity to your investment strategy and reduces the ability to sleep well at night. We believe your time is better spent focusing on work and increasing your income and saving money as opposed to dicking around with selling puts. And as we said, that only makes sense for people with bigger accounts, more sophisticated investors, as it should. So, cash secured puts works best for people with a large amount of AUM. It works best for stocks you plan to hold for the long term, but if you have such high convictions, why not just buy the stock? Don't be surprised to see paper losses offset your income. That premium that you got when shares actually, they don't go just right under the strike price so that you're perfectly set. They may dip huge on earnings or for some reason. So be prepared to see those paper losses. You shouldn't care about them because you have such strong convictions about the stock. If you want to sleep well at night, just employ standard dollar cost averaging practices and spend your time focusing on increasing income. Now, before I put up another video here for you to watch, please click the Nanalyze logo on the right, subscribe to our channel, support our work, and then I've put up that previous video I talked about in which everybody responded to about selling puts, and of course we'll cover covered calls in a future video. Thanks for taking the time to watch this today.